Have you ever wondered how to invest your nest egg once you retire? To keep yourself from running out of money in your 80s and 90s, you need the right asset allocation, or mix of stocks, bonds, and alternatives to maintain your lifestyle against inflation, interest rate risk, and spontaneous health events. So what is that ideal investment allocation anyway? Enter the URS bucket strategy for retirement. There are a lot of financial gurus on YouTube, but are you listening to a qualified professional who has actually helped somebody else retire successfully? I have spent the last decade of my life not only studying finance, but managing millions of dollars for our clients who are approaching, newly, and in retirement. I know exactly how to build an investment allocation that will last 30 to 40 years, and today I'm going to share our strategy. Before I get started though, please be sure to like and subscribe to our channel. This helps us get this information out to as many people as possible, and we thank you in advance. So why do you need to reconsider your investment strategy upon retirement anyway? Can't you just keep your portfolio as is and pull income as needed? Well, that depends. The biggest investment risk retirees face today is something called the sequence of returns risk. This is a phenomenon that involves the order and timing of poor investment returns and the timing and size of your withdrawals. Let's say that you had $1 million nest egg and you retired at the beginning of 2022. You were invested exclusively in the S&P 500 index and you pulled out $4,000 per month or $48,000 that year to maintain your lifestyle. The S&P lost roughly 19% for the year. This means that you didn't just lose 19%, but you lost 23.8% because you also pulled 4.8% out as income. When you tap into your portfolio as it's losing value at the beginning of your retirement, your chances of running out of money over 20 years are significantly higher than someone with the same amount of money in withdrawals that experienced a bullish first few years of retirement. Because no one can control the sequence of returns of the stock market, it's crucial that you segment or bucket your money based on your income needs over different time frames. That way, your lifestyle is always protected. While many iterations of the bucket strategy are flawed, we think we've come up with the best version for today's economic climate so that you can still build wealth while protecting your short-term income needs. The concept of bucketing is pretty straightforward. Segment your investable assets into 3 buckets based on time frame. Here's our framework. The first bucket, we call it the green bucket, is the money that you'll need for the first 5 years of retirement. The goal of this bucket is to stabilize principal to meet income needs not met by other sources. Therefore, it must be invested in assets where you cannot lose principal. Think high-yield savings accounts, treasury bills and bonds, fixed annuities, and CDs. The silver lining of higher interest rates is that these green bucket assets are now yielding anywhere from 4 to 6%, which is triple the yield we were getting just 2 years ago. The second bucket, or the yellow bucket, is for the money that you'll need between years 5 through 15 of retirement and should be invested in a balanced manner. A mix of treasury bonds, high-quality individual bonds, longer-term CDs and fixed annuities, as well as index funds and dividend-paying stocks can fill this bucket to provide a mix of income and steady growth. And lastly, the third bucket, the red bucket, is the money that you won't need to touch for at least 15 years. This is your long-term bucket and as such can be invested exclusively in stocks, real estate, and perhaps an allocation to more volatile alternatives. Why 15 years? Because the S&P 500 index has never lost over a 15-year time frame. So historically, 15 years has allowed plenty of time to recover if we experience a major bear market lasting several years in a row. This bucket is all gas, no brakes, and has the highest potential for big growth over the long term. So how do you maintain these buckets? Well, as you spend down bucket 1, the income, dividends, and bond coupon payments from bucket 2 will automatically replenish bucket 1. If these yields aren't enough to fully replenish bucket 1, then you can withdraw some principal from the fixed assets in bucket 2, still leaving your stock portfolio untouched. As you age, you will need to start selling some of these stock positions to maintain your lifestyle. We recommend doing this every 10 years to allow your stocks to have the highest chance of growth before trimming. However, we do believe that most people should always have at least 30 to 40% of their portfolio invested in stock indexes at any given time or age. Thank you so much for watching. If you found this video helpful, please like, subscribe, and comment below, and we'll see you next time.